like I said, we're going to start with my amazing friend, and I would say one of my mentors in this industry. And Al Hensling is going to talk about hard money loans. He is the president and founder of United American Mortgage. He's an exceptional resource for all of us on the call. He is incredibly knowledgeable. He has a career in this industry. He also is an amazing, lovely human, very kind human. And that to me is more important than anything else. So with that being said, Al is also an amazing real estate investor and has his own fund as well. But I'm going to let Al take it over. And Al, you take it away and start talking. Give us the 411 on hard money loans. I get asked about it all the time. I'm super excited that I can do hard money loans now, but I'd like you to just take a minute to educate everybody who's listening to this about hard money loans and give us the details on what we need to know.
Absolutely. Well, it's my pleasure to be here and to be able to address everyone and provide the information. Hard money loans are really somewhat of a misnomer because most people think that they're the point of last resort. And that was the connotation that was attached to them for years. But really, what has evolved in the marketplace, so what we refer to as private placement hard money loans, and the importance of these type of loans in the marketplace and understanding what their purpose and how they actually function is so incredibly critical to the real estate environment. So essentially, a private placement hard money loan or private placement loan is alternative financing. Not everyone can qualify in a traditional sense. And that could be any number of reasons, whether it be credit quality, speed, ease of use, inability to provide the type of documentation that a traditional loan might require. So with the private placement types of loans, they're predominantly based on the valuation of the property and the ability for that individual or entity to be able to repay that loan. And oftentimes the loans are required to be done very, very quickly. And that's where the lack of the requirements for documentation of income or the traditional underwriting standards. This provides a vehicle that can be done very quickly. I mean, we have been called into situations where for some reason, maybe traditional financing has fallen out and they have to close. And it may be because of a tax consequence that's coming up. It could be that the fear of losing the transaction or the eligibility to be able to purchase that property. But we've actually closed hard money loans in as little as 3 days.
Wow, that's pretty fast. So just so I understand, I mean, speed is of the essence sometimes, right? And
Correct.
I always tell my clients, I'm like, hey, if we're waiving financing contingencies, we've got to have a plan A, B, C, D. I have a plan E, F, G in my head, just so I can sleep at night. But so in situations where you've seen financing fall apart, like you've closed turnaround and closed financing within 3 days on hard money or private money. Is that accurate?
That is correct.
Wow. And the reason for that is because it doesn't follow TRID, correct? Which is the requirements for traditional mortgages.
That is correct. So in many cases, these loans are written as business purpose loans. So under the premise of a business purpose loan, the traditional standards for regulatory compliance and disclosures are not required. So it opens up the ability to operate in a very quick fashion. For those of you that aren't aware, a traditional loan, there is an MLDA requirement in terms of an amount of time for disclosures that have to be recognized and achieved before you could close a loan. And that represents about 8 days.
Right. And we do that too, where we close loans in 8 days on the traditional side, but the 3 days on the business loan on hard money is pretty fascinating. Awesome. Sorry, I didn't mean to interrupt you. I just think that's
No, no, not at all. No,
a
that's a
note.
very good point there. So the way that private placement loans work is that, we are going to evaluate the collateral, which is the property in most cases, which is what we attach and we collateralize the loans with. And then we look at what the request is. Then we also look at what the potential exit strategy, because most private placement, hard money types of loans are there for a short-term fix. So it's getting an individual or an entity or an investor, whomever it might be, in a position to accommodate a specific need that needs to be done in a very timely fashion. And then we look towards, as I mentioned, towards the exit strategy. So how are we going to replace this financing in the future? Oftentimes, we'll have a situation where someone is trying to secure a property that they know that they're going to get a construction loan. So it may be a vacant piece of land that they want to secure the property. Then they're going to go and get a construction loan. And within the construction loan, then the hard money loan would be paid off. So that would be how we would retire it. And that would be how the transaction or the exit strategy would be put into place.
So I think this is an important point, Al. So when considering getting hard money loans, and we get asked all the time for this, it's like, okay, there's considerations on this. What's our timeline? But then the exit strategy is a big piece of this, right? So understanding that up front before the execution of the hard money loan is really critically important. Is that what you're saying?
Yes, very much so. Because as an investor, and the fact that these are short-term loans, so, and as Stacia mentioned, I am a hard money lender myself. I have a fund that I manage. So, our primary consideration is, of course, preservation of capital, the loan that we've made, but more importantly is that we don't want to put someone in a position that they don't have an exit strategy, because then we're just trading one problem for another.
That's
So
right.
it's really critical that we have a complete understanding of the transaction, what the objectives and goals are in taking this type of financing. And that creates a solution for whatever that we're solving for.
Right.
So
Al, sorry, go ahead. I didn't mean to interrupt.
So I was going to say, another area that we use these for are bridge.
Right.
So in many cases, and as we have a very competitive environment in real estate transactions and a limited inventory level, I can't tell you how many times we hear of our clients losing the opportunity to purchase property because they may be contingent.
Right.
But they have tons of equity, or significant amount of equity in their home that they need to tap so that they can go non-contingent. And a hard money private placement bridge type of loan is one of the ways to be able to accomplish that.
Right. Yeah. I mean, I think this is like one of the things I'm most excited about is the ability to do these now for my clients, where if you're in a position where you've got a army behind you of humans living with you, it would be very uncomfortable to displace that package of humans I have with me, and move multiple times. So it's nice to have that as an option for people so that they can get in to, if they find that right property. I mean, I'm sure you've been called in your career, and I've been called in my career Saturday night at 7 o'clock, and it's like, I wasn't really looking for a house, but I found something that's just perfect for us. And we are not, they need to be contingent. They don't qualify for a traditional bridge loan. This is a great interim solution, I think.
It is. And even for individuals that are trying to buy properties that may have a spotty credit history, here again, it's the criteria really is mostly property dependent and collateral dependent.
Yeah, all collateral dependent. Yeah, it's such a different mindset shift. And like when I'm talking to, real estate agents and advisors and CPAs about this so they can educate their clients, it's like, it's hard for people to conceptualize because it's a business loan. It's on the collateral of the property. And that's really where sometimes where the analysis lies, right? Versus the traditional mortgage, a sense on qualifications for an individual.
Correct. Now, with the fact that we are underwriting these loans and reviewing them based on a collateral basis, there is a higher interest rate that's associated with these loans, and there is a cost component. So the individual that is looking for this type of loan, we have to do a very good job of explaining to them that this is an opportunity cost. So it's a solution for a lot of folks. It's an opportunity cost that they're going to have to bear, and it does come with that higher interest rate, and there are fees that are involved with it. And as these are short-term loans, in most cases, or in many cases, they do have to understand that they are going to be paying points and fees to be able to obtain this type of financing.
That's right. Yep. So you pay for it. But again, with the opportunity costs on it, sometimes it is maybe one of the only solutions that really exists and makes sense for the right situation.
Exactly. And that's why, what we've always done, and in preparing our clients for it, is that we go through the entire process so that they fully understand what the cost is, what the timeline, and then also what the ability and solution that this is providing for them that will help solve their particular situation. So they're not for everybody, but it is a solution. And as Stacia, as I know how you have built your business, it really is about providing solutions for your clients. And although they may not like the solution, it may be too costly for them, or it may not be exactly what they're looking for, this does create an opportunity. And there is a lot of collaboration on these types of loans as well, because, for example, they may be concerned about what the cost is, but maybe to make it happen, the seller can participate, the business partners can participate. It really becomes a collaborative effort, but there's a lot of dialogue that goes along with it in establishing, what is good and what is going to be most appropriate for your client.
Yeah. Al, quickly, so I'm sure some people that will be listening to this or are attending might have a question. So like Al, and I know the answer to this, but this is more for the audience.
Sure.
Al, can you use hard money loans? You mentioned, vacant land. Obviously we do land loans too, right? But that might not be the right fit for that specific client or opportunity.
Right.
Distressed properties, obviously properties that have a lot of problems or issues that aren't going to pass a traditional appraisal requirements on health and safety, but also multi-unit. I know that we can use hard money loans sometimes for our commercial investors, multi-unit, because we do commercial loans over 4 units as well. Is hard money loans a good fit for those type of situations also?
Well, they are, and here's a perfect example, because there may be a property that an individual can purchase, such as a multifamily, that is in a distressed mode. And they're trying to achieve a particular leverage against that property. But if we have to use the current condition of the property as well as the current rents before remediation or before improvement, this provides an opportunity for the individual to purchase the property, do whatever repairs, in some cases, get them fully rented, so that they can then go into the marketplace with the property in its best possible condition, both physically and also from a economic standpoint, by having it rented appropriately. Because when you get into traditional financing, particularly for multifamily and commercial types of properties, it is really a function of what the rents of the property are.
That's right. Yep.
So this creates an opportunity for somebody to buy it, improve the property, and get it to its best financial condition to then go and achieve the best available financing long term, then
Right.
this type of loan works extremely well. We will also, in cases, a hard money loan can be either a first or it can be a second trustee. So in
Mhm.
some cases, somebody may be able to assume a property, but they don't have the ability or the access to capital to do the necessary improvements. So we can look at what the value of the property from a finished standpoint after the utilization of these funds and use that so that we can make a loan to them, say, for example, in a second position, that will allow them to do the necessary improvements. And here again, be able to monetize those improvements to achieve a exit strategy for the best possible financing.
Yeah, that's right. Hard money loans are super, super cool. They have such a bad connotation, and I'm on a mission to change that. I want people to understand the opportunity that's behind them and the ability to use hard money loans to build long-term wealth in real estate. And that's really the goal. Every single time we work with somebody, right, is helping people understand that this is an investment, and we look at this collateral as assets, and what's that asset going to perform over a period of time. So Al, thank you so much. I so appreciate you coming on, sharing your wisdom and knowledge. I'm super excited that I'm able to do hard money loans now, and have such an amazing mentor to help and guide any of our clients through this process. It's a pleasure, and you're just always just a lovely human, and I appreciate your time because I know how
Oh,
busy you are.
thank you. Yeah, we look forward to the opportunity to assist you with these.
Thanks, Al.
All right, thank you.
All right, so we are going to move in to some of the economic climate of what's happening today. It is crazy. Al and I were just talking about how this market today is, my analogy for the market is she's kind of like a teenage girl. She's all over the place. I can say that because I used to be one. But we're going to talk a little bit about some of the things that are happening today. Is actually a fascinating economic news day on the day of the leap year. Leap year day. My son was explaining to me what leap years are and how they happen, and back in the Roman times, why they did this, et cetera. It's really interesting, actually. I learned something from my 9-year-old every single day. But really what I want to talk to you guys about is around some of the basic economic principles. And if you've worked with me in the past, you've gotten this education, but I just cannot say it enough. So I'm going to repeat some things that I think are really applicable and relevant. Mortgage rates are really driven by inflation. Inflation is a very fascinating economic kind of data point in our economy right now, and mortgage rates are very responsive to inflation. The thing I kind of want to talk about is around inflation. So how do we measure inflation, and what is inflation? Inflation is too many dollars chasing too few goods. So at the fundamental level, that's what it is. Too many dollars chasing too few goods. And during the pandemic, the federal government put an influx of capital into the bond market and bought $9.5 trillion of bonds, and put a just ton of money in that market, and then also stimulus packages in the economy, so that we didn't really feel or talk about inflation during one of the largest global supply chain events we've ever had in our modern world. So again, few goods, lots of money, few goods. So we should have really been talking about inflation, but we just didn't feel it then. And again, that was based on the Fed's monetary policies. Well, what do the Feds look at when they talk about inflation? I mean, you can't go anywhere without the word inflation being kind of put into your face. And so I want to educate you on what are the things that the Feds look at. So we've got the core consumer price index, and we've got the personal consumption expenditure index, PCE. So CPI and PCE. The Feds have a target core rate of 2% with inflation. The core is removing things like food and energy. So they say they can't control the weather patterns, which influences our food supply chain, and they can't control politics and such, which impacts energy prices, oil, et cetera. So they strip those factors out, and then they say that they can influence everything else with our monetary policies. So If you guys have seen in the media, Feds raise rates, that's Jerome Powell and federal chair members. And what they're doing is they're raising short-term rates. They're raising short-term debt. So car loans, student loans, credit cards, commercial, business, and industrial loans. All right. And CPI and PCE are kind of like their North Stars of how they measure these things. And within CPI and PCE, there's varying levels of what they look at in terms of our spending in the economy. Okay. So one of my favorite stories to talk about PCE or CPI, excuse me, and PCE was we saw this in like just huge increase in inflation. I laugh, it's not really funny. Several months ago, it was like right out of, it was actually a year and a half ago after the pandemic. And we saw this spike in dog grooming. And I was like, oh, I have a big dog that needs to be groomed. Never had a dog that needed to be groomed. My dog now needs to be groomed. And the reason for that is pandemic puppies. Everybody went out and bought a pandemic puppy. So like dog grooming like went way up. And that was a big factor in inflation, which is crazy, but it's these little things that can really impact our inflation readings. So what we're going to talk about today is like really looking at core inflation. So core inflation is, again, everything that we spend money on, except for food and energy costs, okay? And the Feds have a target number of 2% core inflation. What you're looking at on the slide here is we have an average of CPI and PCE averaged together. We actually now could have put up the February readings, but I did not have time this morning because I've been in meetings, but we just got the PCE numbers this morning. Headline went from 2.4% to 2.6%. So headline just means that we're including food and energy into those numbers. And core actually dropped from 2.9% on PCE down to 2.8 or around 2.85% today. So that's a good thing. But unfortunately, our inflation numbers with PCE today, you know, we're up again, so which is not a great thing. So we're continuing to see this sort of yo-yo effect on inflation. I think it's a fascinating economic time. You know, you can't inject that much medicine during the pandemic with the Fed's monetary policies and then just rip the cord out and expect the economy not to go into some sort of like detox situation. So that's kind of what we're in. It's like, what's happening? You know, the Feds like to look back at a 6-month trend on inflation. That's really what they talk about, is the 6 months trend in inflation and what it was. The PCE numbers say we're not good. And, you know, the 6-month inflation trend is potentially not going to be as favorable. Going into this year, there were many traders in the bond market, and we're thinking the Feds were going to do some major rate cuts by now. I don't think that's the case. I think that we're going to continue to see some of this like up and down movement with mortgage rates. Remember, when the Feds raise rates, it has nothing to do with mortgage rates. It's the short-term debt, short-term rates, but it does have an indirect impact into the bond market, which is where mortgage rates reside. Okay. Jobless claims are a big piece of this too. Jobless claims, actually continuing jobless claims today, we just got those numbers increased 45,000. So we're at 1.905 million, which is the second highest reading since November of 2021. Okay, this is a big deal. And then initial jobless claims increased 13,000 to 215,000. Okay. Now let's talk about housing. So what you're looking at here is on inflation. I'm looking at my other screen because I have multiple screens all around me, but inflation, core inflation, shelter is a big piece of this. Okay. You can see that 44% of the core CPI is made up by shelter costs. Okay, rents and owner's equivalent rent, and then 21% of core PCE. All right, that's a big deal. But inflation with shelter costs, it's like a 12-month average. So it's like this, like some people have used the analogy of a roller coaster. So it's like a 12-month average. And so when we're looking at this, the data actually skews and is a little bit lagged in here. And those numbers get reported in the inflation numbers. Apartment List actually came out with some numbers today. And they're a good economic reader in terms of rents. And they said that the new rents are actually down 1% year over year. And vacancy is 6.6%. We should eventually start to see these quote unquote shelter number, these numbers reported in our shelter numbers, which is then going to impact inflation. And remember, we care about inflation because mortgage rates are influenced by inflation, all right? And the Fed have this target number on core inflation of 2%. So I think some of these numbers that we're seeing, again, from apartment list, on new rents starting trending down year over year, it's at 1%. And then vacancy at 6.6%. I do think we're going to start to see those numbers in our inflation numbers in the future. All right, we're going to move through here. Okay. I do not gamble. I hate gambling, but I know people do. So we're gonna talk about odds here. So, the federal rate odds. I do think this is a fascinating statistic. It's like for every $17 of money spent in the United States, $16 are spent on credit. Consumer credit debt right now is through the roof. This is the thing that keeps me up. I am concerned about this. People are holding credit card debt. I always ask people, what's your credit card rate? It's fascinating. People are, they know their mortgage rate like that, but they never know their credit card rate. They don't know their car rate. I understand because it's a bigger loan, but still, I'm like, what's that credit card rate? Oh, 12%. I'm like, no. It's more like 30 right now. Okay. Because that's attached to the federal rate and the Fed rate's pretty high. So when we think about the federal rate, we want to talk about the Fed's cutting rates. All right. Beginning actually in December, there was some odds suggesting that by June, they were going to cut by 75 basis points. Actually, some new numbers came out today, and some bond traders are suggesting and some traders in the economy are suggesting it's going to be a 25 basis point drop by June. About 91% are suggesting that. There are some other revisions to some of the numbers that came out beginning of the year, where again, because there's been some adjustments on jobless claims and inflation numbers, there's always adjustments and seasonal adjustments that come into play. So these numbers kind of get released and they get revised about a month later. So what I believe will happen based on, again, really smart people that I study and I think are good at this, is we might see about 325 basis point decreases in the federal rate throughout 2024. The good news, though, is as many of these people are kind of dot plotting that into 2025, we should see rates come down even more. And then again in 2026 and beyond. So we're going to start seeing this downward trend. We've been in this upward trend. We're going into a downward trend, and that is a good thing for mortgage rates and short-term debt as well. All right. Let's keep going here. So mortgage rates and recessions. We're not going back to the 2s and 3s. All right. Are we going into recession? Are we in a recession? I just keep saying, I think we are. I think I just have too many personal stories of people calling me who are in a situation. I think the consumer credit debt right now is really high. I do think jobless claims are going to continue to catch up, but there still is money out there being spent. So that being said, regardless of whether we're going into a recession or not, I want to make sure that we're really clear that it's not anticipated to go back to the 3s and 2s right now. Again, this was created by the federal government's monetary policies called quantitative easing. They put an influx of capital, brought debt down to the lowest levels. We're not going back to that. All right. Rate environment right now, we're in the 6s. We hit the 7s at one point sometime this year. Now we're back in the 6s. I think it's going to be this yo-yo effect, up and down, up and down. There are some people that are suggesting we might be into the low 6s, high 5s by the end of the year. To me, that's a little bullish, a little crystal ball-y, but I do think we will be seeing that for sure moving into 2024. All right, housing and recession. So, housing is still staying strong. And the reason for this, I cannot stress this enough, is the economic climate that we are in terms of supply and demand, supply and demand, supply and demand, supply and demand. All right. So housing has stayed really strong. We have seen an increase in housing in 2023 from a price index perspective. Yes, there were some markets that were, that were impacted, but really there's reasons why we're starting to see housing, demands on housing and housing prices, bidding wars in certain markets. There are certain markets that are softer. I'm not suggesting that every market has bidding wars happening. There are markets that are softer that have an influx of inventory. However, the amount of individuals who are putting pressure on housing, millennials, post-millennials are coming into age to enter the workforce, puts pressure on all housing, all housing. I always say, one thing that's certain is there's not more dirt coming on this planet. There's actually probably less. And so dirt is a commodity and there's just not a lot of places for people to go. And the generations keep growing. They keep growing and growing and growing and getting bigger. Builders were really gun shy after the Great Recession, the Big Short days in the early 2000s. We had this big population drop in growth back then, and that's because 30 years prior, Roe versus Wade was put into effect. And so we had a slowdown in population growth, but builders weren't paying attention to that. They were just doing completions. So what you're looking at is completions and birth rates. And so now we're seeing completions kind of come back up again, which is good because we do need housing, but they're still not caught up. There's still not enough housing starts out there to support the population growth that is coming and will continue to come. The other thing that we're going to talk about on here, oops, my slide goes forward. Okay, thank you. Is just inventory. So, we just truly have an inventory crisis. I just can't express this enough. I always like to say everything is loan locked. Like you're in gridlock or we're in loan lock land. It's very painful for people to go from 2% to 7% or 3% to 6%. It does take a lot of discomfort to move into those increased interest rates for those people that do own houses. And so we are seeing locked inventory. We are seeing people stay put. I have anecdotal story after anecdotal story across the United States for my clients, because I do business in multiple states, where people are just staying put. Doesn't matter that it's too small. They don't want to go buy something else because their affordability is just not in the same market. They would actually be trading the same house for the same house because of affordability. And that doesn't necessarily make sense. I do believe with interest rates dropping, we're going to start to see inventory come down or increase. With interest rates dropping, we'll see inventory increase. I do also think that the credit card spending and debt in the future, or that's happening right now, is going to unveil itself into the future. And we're going to start to see people having to give up properties. They're just going to have to sell because of the financial situations that they are in. Now, equity is another thing. So we have a lot of equity in properties right now. 2023 equity did decrease. Again, these are national numbers. So your market might not have decreased, but some markets have. So again, you're looking at national numbers here, and this is from CoreLogic. But I just want you to understand that equity, people still are sitting on a lot of equity. And I do believe that going into the market we're moving into, we're going to continue to see appreciation. This is a very cool map. This is like kind of looking at low housing inventory areas compared to pre-pandemic levels, which I think is fascinating. So if you can look at the map here and find yourself on the map, there you go. We can see the inventory and the low amount of inventory. I mean, nationally, there's a lot more brown on this map than there is teal. Okay. Teal happens to be one of my favorite colors, but there's a lot more brown on this map than teal. And that's not good. We have an inventory crisis. We still don't have a lot of houses for sale. All of this, again, like I said, it's very dependent on mortgage rates, and unemployment, staying stable. But like I said, today, we got some new unemployment numbers that are showing an increase. And again, the second highest reading since November of 2021. All right, let's talk about forecasting. So this is interesting. I actually, if you look at this, if I went back to December and I was looking at all of these institutions forecasting home price appreciation in 2024, it was really low. It was really, really low. The fascinating thing is just even this month, because of the revision on economic numbers from January and from December, is a lot of these institutions actually change their economic forecast in terms of home price appreciation. Why? Because we have an inventory crisis. Why? Because we have a lot of people looking to buy houses that want to qualify, want to buy right now. There's just nowhere for people to buy. And so they did do this adjustment on some of their forecasts for home prices. Again, these are national numbers. So it's not specific to your market. These are national numbers we're looking at. And on average, it's over 2%. It's actually over 2.5%. It's almost 3%. So that's the average of all of these, and there's a lot of other ones out there. I think that these ones I have the most kind of respect for in terms of forecasting because of their positions on data and also technology. So really, really interesting. You can see Morgan Stanley's way down here. The other thing though, so the National Association of Realtors forecasts that sales are actually going to rise by 13%. So that's not house prices. That's actually activity. So we're going to increase by 13% over last year in 2023. All right, affordability. So affordability is something that's in the media, talked about a lot. I just wanted to break down numbers here. So in 2021, let's just say the interest rate was 2.875%. Gosh, that was a beautiful rate. The loan amount was 240,000. Payment on that is about, as principal and interest, $1,000, and income, let's just say, is $4,000. So if we push forward to today, 2024, let's just say the rate's 6.625. We have a $280,000 loan amount because of appreciation, because of market increase. We have an $1,800 payment. And our income is about $4,600. Why is that number on there? Is because ADP, which is pushes out a lot of data around pay and stuff, have risen by 15% since 2021. And again, this is not every single industry. So some industries, I always like to put a disclaimer over there. So it's really not that, it's about a $200 difference. I'm not saying affordability is not really, really hard right now. I'm not discounting that. I would just like to break down. I like to do math and numbers because I am a nerd. But again, just some real life examples to look at. So if you have the ability to buy and you have the desire to buy, first the desire and the ability to buy, it can be a great time to buy because again, this is short-term debt that you're going to be in. You're going to be refinancing out of it. If you are a customer of ours, you're on our automatic refinance program where we monitor the markets for you and absorb certain costs so that you don't have to pay things twice. Okay. And then I just can't beat this drum enough. I've shown the slide before, but I'll show it again. I mean, I think that, wealth can be built within real estate. I think long-term, holding real estate long-term can give you great wealth positions. I think as soon as you have an opportunity to buy something, you should early in your life. I think that actually propels you into the future, even in markets that have a lot of instability, kind of like the market right now. But if you have the ability to buy, and again, the desire and holding that property long-term, I do think that you're going to see nice market appreciation return. We should look at real estate as an asset, much like we look at our retirement accounts, our investment accounts, et cetera. Real estate is an asset. That's how I like to dissect it and break it down with my clients. Let's look at it as an asset. And again, I think that, these numbers are pretty interesting. Why is this? Because it's a limited commodity. Dirt's a limited commodity, guys. There's not more coming onto this planet. The other thing is, follow me. I am on social. I do a lot of educational videos. We are now a mortgage broker, so we have tons of products. The ability that, like I say that where we're at now with United American Mortgage, if we can't do it, nobody can. I mean, we can do so much crazy stuff, non-qualified mortgages, non-QM stuff, plus all the regular things. And then with really competitive interest rates. If anybody has questions, connecting with me is the best way to do things. And I am just super excited that everybody came on to join. If you have any questions, I will be happy to take them. Just pop them into the Q&A. And if not, feel free to reach out to me directly. Again, I appreciate everybody's time. And it's always wonderful to see everybody that likes to jump on these. I recognize some names on here. So thank you for joining. And again, don't hesitate to reach out with any personal questions or happy to be a resource in any way I can.